Yesterday, we talked about how multiple positioning factors confluence to create conditions for a relief rally. Well, we got just that as markets uncoiled from depressed sentiment, oversold levels, and negative positioning. Now, what was the catalyst? Probably a watering down of tariffs. But remember, this can reverse as quickly, especially when policy is as volatile as the markets are. The bigger question, though, is how long does this calm last and is it sustainable? Well, there are three things to watch in our view. First, there is broad economic policy, and it's been fickle to say the least. Attention has been dominated by tariffs, but tax reliefs, deregulations are yet to get a mention. So, on the first count, volatility remains likely to stay elevated. Next is the earnings season that kicks off in about 3 weeks or so. Despite delivering a solid 18% plus earnings growth in the fourth quarter of last year and reasonable forward guidance from big tech, markets were unimpressed, used to seeing spectacular guidance, and so anything less wasn't good enough. So, to some extent, with watered down expectations, the bar may be easier to cross, but either way, earnings seasons are volatile periods anyway. And then there is the macro, at best a mixed bag. There is some slowdown in consumption and housing, but nowhere near dramatic, and all probably due to what has been a remarkably resilient jobs market. So, for all those who are worried about stagflation, there isn't much evidence to support that case. And so, the Fed is likely to stand pat with no reason to panic either way. Net result, policy and earnings will keep volatility elevated, with the calm from macro unlikely to be enough. And for investors, the message is simple. Don't fight volatility, embrace it. Selling premiums as and when vols spike will be a recurrent opportunity this year in our view. Good morning, this is Sunil Garg from Lighthouse Canton.